Are you secretly losing money without even realizing it? It's true. Every single day, a silent thief called inflation is chipping away at the value of your hard-earned cash, making your savings worth less and less over time. It's a problem most people ignore, but you don't have to. Think about it. What cost $10 5 years ago might now cost $12 or even $15. That means the money you saved in your bank account, sitting still, is slowly losing its purchasing power. It's like running on a treadmill that's constantly moving backwards. For example, if you keep $1,000 in a regular savings account, earning almost nothing, after 10 years with just 3% annual inflation, that $1,000 will only buy what about $744 would buy today. You haven't lost a single dollar, but you've lost a quarter of its value. But what if there was a simple, safe way to not only protect your money from this silent thief, but to make it actively grow? What if you could make your money work harder for you than you work for it? This isn't about risky gambles or complicated schemes. It's about understanding a few basic principles that can help any beginner start building real wealth. In the next few minutes, we'll show you exactly how to do it, step by step. By the end of this video, you'll know how to put your money on a fence, turning it into a powerful asset that outpaces inflation and secures your financial future. It's simpler than you think, and it all starts right now. So, what exactly is investing? Forget all the complicated jargon you've heard. At its core, investing is simply putting your money to work for you, instead of just letting it sit there doing nothing. Think of it like planting a tiny seed. You don't just eat the seed. You put it in the ground, give it some time, and with a little patience, it grows into a much bigger plant that can bear fruit. Your money is that seed. When you invest, you're essentially planting your money in something with the expectation that it will grow and give you more money back in the future. It's a way to grow your wealth over time. It's about making your money actively generate more money, rather than just passively existing. Instead of your $100 just being $100 5 years from now, with investing, it could become $150 or even $200. The key is understanding that this growth isn't magic. It comes from putting your money into things that tend to increase in value over time, like businesses or properties. You're becoming a tiny owner of future growth. This is fundamentally different from just saving money, where your cash mostly maintains its value, or, thanks to inflation, even loses buying power over time. Investing aims for actual growth. So you might be thinking, why invest when I can just save? That's a great question. The truth is, saving and investing are like two different tools in your money toolbox, each with its own job. Saving is fantastic for short-term goals. That emergency fund, a new gadget, or a vacation next year. You put money aside in a safe place, like a savings account, knowing it'll be there when you need it. But for long-term goals, like retirement or buying a house many years from now, saving alone can actually leave you behind. Remember that silent thief, inflation. Your saved money might buy less in the future. This is where investing shines. It's for making your money grow over many years, actively working to outpace inflation and build real wealth. Think of it as planting a money tree instead of just storing seeds. Let's look at a quick example. Imagine you have $1,000. If you just save that $1,000 in a typical bank account, earning 0% interest for 10 years, guess what? You still have exactly $1,000. Now, imagine you invest that same $1,000 over 10 years, earning a modest average of 7% annually. You'd be amazed. That initial $1,000 would grow to nearly $1,967. That's almost double your money just by putting it to work. The key difference is time and growth. Saving is for access. Investing is for long-term accumulation. So where do you even start with investing? Forget trying to pick the next Amazon or Tesla. For beginners, the absolute best and safest place to put your money is something called an index fund. Think of an index fund like a giant basket filled with hundreds or even thousands of different stocks. Instead of buying one company's stock, you're buying a tiny piece of many companies all at once. The most famous example is an S&P 500 index fund. This fund holds stocks from the 500 largest companies in the United States, like Apple, Microsoft, and Google. This is super important because it provides instant diversification. If one company in the S&P 500 has a bad year, it barely affects your overall investment because you own so many others. It's like not putting all your eggs in one basket. It dramatically reduces your risk compared to buying individual stocks. You're riding the overall economic wave, not just hoping one specific boat floats. Index funds are incredibly simple, safe, and have historically delivered solid returns over the long term. They are designed to match the performance of the entire market, not beat it. This set-it-and-forget-it approach is why they are the ultimate beginner-friendly investment. You don't need to be an expert. You just need to start. So how do these index funds actually make your money grow, like a lot? It all comes down to something called compounding, which Albert Einstein supposedly called the eighth wonder of the world. Imagine your money earning money, and then that new money starts earning money too. It's like a snowball rolling downhill, getting bigger and faster. Let's put some real numbers to it so you can see the magic. Say you decide to invest just $100 every single month into a low-cost index fund. That's like cutting out a few coffees or a couple of takeout meals. You keep doing this consistently, month after month, year after year. Now, let's fast forward 30 years, which might seem like a long time, but for financial planning, it flies by. With an average historical return of 7% per year from the stock market, which index funds aim to mirror your small monthly contributions, turn into something incredible. You would have put in $36,000 of your own money over those 3 decades. But thanks to the power of compounding, that $36,000 you invested wouldn't just be $36,000. It would likely grow to over $100,000. Yes, over $100,000 just from $100 a month. That extra $64,000 plus is purely your money working for you, multiplying itself. This isn't some get-rich-quick scheme. It's consistent, long-term wealth building, proven by history. The key is to start early and be patient. Time is your biggest ally when it comes to compounding, giving your money the space and opportunity to truly flourish. Now for the ultimate low-stress, beginner-friendly investing strategy, the set-it-and-forget-it method. This isn't about timing the market, trying to buy low and sell high, which even pros struggle with. Instead, it's about consistent, disciplined action over time. This method relies on 2 powerful concepts: dollar cost averaging and long-term investing. Dollar cost averaging simply means investing a fixed amount of money regularly, say $100 every month, regardless of what the market is doing. Whether prices are up or down, you keep buying. When prices are high, your fixed amount buys fewer shares. When prices are low, your same fixed amount buys more shares. Over time, this averages out your purchase price, reducing the risk of buying everything at a market peak. It's like evening out the bumps in the road. The forget-it part comes in with long-term investing. Once you set up your regular contributions, you let your money compound and grow over years, even decades. Don't constantly check your portfolio or panic during market dips. Market downturns, while scary in the short term, actually become opportunities to buy more shares at a lower price, thanks to dollar cost averaging. Your goal isn't to get rich overnight, but to steadily build wealth over the long haul. This low-stress approach removes emotion from investing, which is often the biggest enemy of beginners. Stick with your plan, trust the power of compounding and diversification, and let time do the heavy lifting for your money. So, what's the big takeaway from all this? If you remember only one thing, let it be this: consistent, simple investing in diversified funds like index funds is the safest, most effective way for beginners to truly grow their money. Forget trying to pick individual stocks or time the market. That's a high-stress game for experienced pros, and it's where many beginners lose money. Your job is simply to keep planting those seeds regularly. We're talking about a set-it-and-forget-it strategy. Automate a small contribution each month, even if it's just $50 or $100. Over decades, that consistency combined with compounding build serious wealth. The biggest mistake you can make now is doing nothing. Inflation is silently eroding your savings, making your money weaker every day it sits still. You have the power to fight back. Your first step to wealth doesn't need to be grand. It could be as simple as researching a low-cost S&P 500 index fund today, or just setting up a small recurring transfer. Don't overthink it, just start. The sooner you begin, the more time compounding has to work its magic. Every month you delay is potential growth you're leaving on the table. We're here to make money simple, not scary. If you found this helpful, hit that subscribe button for more straightforward tips to help you build your financial future, one wise penny at a time.